All right, well, hi everyone, and welcome to this webinar on investing in agribusinesses, what makes an agribusiness attractive from an investor's perspective. I'll pass it right over to Aviva Kutnick from USAID to take us through the first couple of slides, and then I will introduce myself right afterwards. So Aviva, over to you.
Great, welcome everyone. Thank you for joining us. I'm Aviva Kutnick from USAID's Bureau for Food Security, Office of Market Partnership and Innovations. And we're so happy to be hosting this 5-part webinar series on tools and strategies for catalyzing finance in the agriculture sector. It's really an opportunity for both the USAID development community and others to learn together how to catalyze finance broadly in agriculture. This is our second webinar topic. Last week, we were able to learn about the Development Credit Authority and USAID's tool in terms of de-risking access to agricultural finance. That webinar is available on AgriLinks. If you didn't get a chance to participate live, you can learn alongside the recorded webinar. And today we're going to be in our second topic. We're going to be looking at investing in agribusinesses, what makes an agribusiness attractive from an investor perspective. And then we have 3 more topics you can see on the slide in upcoming weeks, and we hope you'll be able to join us as well as invite others to join as well. So the topics are critical for our work, and we see the learning objectives, and we shouldn't get bogged down. If we're not finance experts right now, that's okay, because the course is designed for both an introduction to the topics as well as for more advanced practitioners to really delve in deep. So if you're not familiar with some of the technical jargon, not to worry, there's a pre-read document attached that'll help define some things, and we'll also have an opportunity for question and answer in the chat box throughout the webinar if you have specific questions, as well as you're welcome to follow up afterwards. So just to review some of our learning objectives, things we hope to accomplish together. Today we hope to understand why investors invest in agribusinesses in the first place, what they're looking for. How to determine if an agribusiness is an attractive investment opportunity. Clearly, from our development perspective, we have an approach why we would invest in a certain agribusiness for development impact, but what are investors looking for is a bit different, and we're going to delve into that. We're also going to be discussing how USAID can catalyze investment through different opportunities, and then we're going to walk through together a case study on a specific agribusiness, and then we'll have a real opportunity for interaction and Q&A and discussion there. So we hope that you enjoy the next hour and a half or so, and I will turn it over to Sham and Mark to continue. But just before that, I'll make a plug again for AgriLinks. So all of these webinars are available on AgriLinks, and we encourage you to contribute content to AgriLinks, as well as to download content and to interact with it as the learning platform. So now I'll pass it to Sham and Mark to continue the webinar. Thanks very much.
Great. Thanks so much, Aviva, for the introduction. So as just a quick round of introductions from my end, my name is Sham Sundaram. I'm an associate partner at Dahlberg Advisors. I've been working very closely with Aviva and Patrick and others on the investment support program from Dahlberg's side. And I did a lot of our work in designing learning programs. In particular, in the past, I've facilitated a 3-day agricultural finance training for USAID staff in Washington, D.C. And I'll invite my colleague Mark to introduce himself as well.
Hi, everyone. It's great to be here. My name is Mark. I'm the project manager of this broader series, which includes not only the 5 webinars that Aviva mentioned, but some knowledge products as well in agricultural finance that we will be distributing as well. At Dahlberg, I focus mostly on topics such as inclusive finance and strategy. And I've also been on the other side of this discussion as an entrepreneur, as a business owner, trying to raise money from investors and figuring out what they want and how to do it. So thanks.
Thanks, Mark. And so we'll be going back and forth throughout this training, taking on different topics. So you'll hear from both of us over the next hour and a half. Where just a few kind of quick rules of the road. As Aviva mentioned, this is meant to be very much a learning environment. And so we do want you to ask questions as much as you want and can. You can either jump in or you can use the chat window, which is on your bottom right-hand side. Feel free to jump in at any point. Don't have to wait for a specific moment to ask questions. If you're not talking, just remember to mute yourself. There can often be some background noise, and so we just want to make sure that we avoid that wherever possible. And then if anything is ever unclear, just do flag it. It may be that someone else is struggling with the same concept or topic or issue, and so we're more than happy to clarify as need be. And finally, before we jump into the actual content, one thing we just want to be clear on is just the financial terminology. So we will be going through quite a few different financial terms. And as Aviva mentioned, the purpose of this very much is to get you familiar with them. We don't expect you to be an expert by the end of today, but just that you kind of understand what these terms mean and how they're used. We did send through a pre-reading document. If you don't have it yet, please send an email to Aviva Kutnik. The email is on the screen, and she can make sure to send it to you. And as we go through different terms, we will define them, but if there are specific terms that you don't understand or you do want more clarity on, feel free to ask again directly through the audio or in the chat window. More than happy to clarify. So with that, I'll pass it over to Mark, and he can take us through the first section on what makes an agribusiness investable. So Mark, over to you.
Sure. Thanks, Sham. And just to reemphasize what Aviva and Sham have said, we're going to use some technical terms, but the point isn't to memorize them or become finance experts. It's really about understanding the concepts and how investors approach these decisions so that we can more effectively engage with commercial investors. So this first section, what makes an agribusiness investable, it's really answering the why question, which is why do investors invest in agriculture, and then what is the general framework that they use. And then we'll get in later into the how they do it. So first, why do investors invest in agriculture? After all, there's lots of different opportunities for investors, technology, infrastructure, energy. So why agriculture? The answer is there's lots of reasons, but they fall into two different categories, which we're calling here pull and push factors. Pull really means that what is happening in the market is really so interesting and so compelling that you really can't help but pay attention. It pulls your attention in. So some of the biggest pull factors are, first, number one, agriculture is a huge market. There's 7.2 billion people in the world, and it's growing, and everyone eats, right? So it's a huge market with unlimited potential. Number two, there's a huge need for financing in agriculture. Just as to achieve the second UN Sustainable Development Goal of zero hunger, $260 billion is needed per year in agriculture for everything from new seeds to new machinery to new technology. What that money can really be put to productive use. Number three, prior success stories from other investors. Investors talk to each other, and a lot of investors have not only generated a lot of social impact, but gotten commercial returns too. And so investors pay attention to that and are interested and want to learn more. And number four, the government provision of subsidies. Obviously, governments and the public sector and multilaterals are involved in the sector. And so when you have that kind of support, it can increase the attractiveness of investing in agriculture. So those are some very compelling reasons why investors, their attention is pulled into agriculture. There's also these push factors, which is essentially what is happening inside the investment firm itself. Which is number one, they're looking for returns. And so when you're looking for a specific kind of return where you can invest your money, agriculture comes up top of the list. It can be a very attractive opportunity for them. And number two, the potential to apply innovation. As a lot of investors, specialize in certain sectors. They know how to transform industries, or they know how to apply technology to a company to make it more efficient. And so agriculture, obviously being pretty low tech in emerging markets, there's a lot of potential for them to add value as well. So in short, it's very attractive for them. So, what is the framework that they use to evaluate whether a specific opportunity is a good investment opportunity or not? Bankers and investors use lots of technical terms or buzzwords or different methodologies, but at the end of the day, they all come down to a pretty simple framework, which is, on one hand, they're looking at how much money they think they can make on their investment. You put in $1 million and you get back, 1.2 million. Weighed against the risks, what is the probability that investment will work out, and the transaction costs. And that's pretty much it at a high level. There's different areas where they focus and different flavors of this, but this is essentially it. This is also known as risk versus reward essentially. We've added transaction costs here for this context, which we'll go into in a moment. So what do each of these mean in the investment context? So one important thing about return is that investors are comparing opportunities in agriculture versus other opportunities. They're looking at a lot of companies at the same time. So they're not only looking for a specific number, they're looking for what else could they do with that money. So different investors have different strategies, but it's important to realize they're not analyzing opportunities in a vacuum. On risk, obviously investors have different risk profiles. Some are willing to take a lot of risk, some are not willing to take risk at all. But what's important for all of them is to quantify the likelihood that they think their investment's going to work out. No investor expects, out of 10 investments they've made to all 10 be home runs, right? And so some might expect 2 to not work out, or some might expect 5 not to work out, but they all have different tolerances there. And then transaction cost. The transaction cost is the specific, the amount of money or the amount of resources that are needed to do the deal. So very few investors will invest in an agribusiness just based on a report, or photos or a phone call, right? They want to go to the firm itself. They want to talk to the people. They want to see firsthand what's happening. And so when a potential opportunity is in a very remote area, hard to get to, and it's expensive and requires lots of trips, that's a factor, and that needs to be built into the decision-making process. And so just to make these terms a bit more concrete with some examples, so on a return, as an example here, say there's an opportunity that's you can invest in a new distribution center for an agricultural product, and you're going to get 20% back. Now, 20% is better than a bank. It's better than the stock market. But to this particular investor, maybe it's not enough because they expect a lot of their other businesses to fail, or they've got other opportunities that look at the same thing. And so that's what I was talking about before, how they compare investment opportunities versus other opportunities. On the risk, different risk profiles. One example here that I'm sure USAID faces, or USAID does face, is when there are capital controls in different countries. So it's not only about, in this example, having an attractive return on your investment, but being able to get your investment back. So say you invest $1 million in a business, an investor invests $1 million in a business, it turns into 1.5, but it's very difficult to get that cash back into the United States or wherever they are to return it to their partners. So some investors will say, we don't look at any opportunities in X markets. So yeah, sorry, I'm just seeing a comment. There's a little bit of feedback. So if it continues, I'll speak closer to the microphone, and if it's still here, I'll put on headphones. And just on transaction costs, as I mentioned, some investors may not even look into certain opportunities that are in rural areas. Apologies. Hopefully this is better. So these are the main definitions: the return, risk, and transaction costs that investors use at the end of the day. So moving on, so how do investors apply this framework? So first we're going to walk through an example of, a specific example of how they look at expected return, risk, and transaction costs. And then if the expected return is greater than the risks and transaction costs, they'll invest commercial financing on their own. No other sort of support is needed. There's another scenario where maybe the investment isn't quite good enough, or there's just something about it that the investor says no. So then the decision there is if the opportunity can be improved to make it investable by increasing the return or reducing the risk or something else. And this is where USAID in particular can play a big role, especially for this webinar, by providing different kinds of support to turn the investor no into a yes. And again, we'll go into some examples here. And then sometimes that's not enough. And one important point for USAID is that USAID obviously works with every box on this screen, the firms with no commercial financing, conditional financing, and commercial financing. In the context of this webinar, there can be a lot of impact on the conditional financing. in particular. Right. So to wrap up this section, this is essentially why investors invest and kind of the framework they use. And then next, we're going to kind of analyze the expected return part of the framework by going through some of the basic finance information that investors look at and what they look for. And so, the good news is that investors, use lots of different buzzwords and different processes, but there's really only two things that kind of matter to an investor when it comes to finances. Well, actually, let me pause here for a second, and also mention what Sean mentioned. If there's any questions at any point up until this point, please feel free to leave a message in the chat window, and we can pause and discuss it. We want to make sure there's lots of opportunity for discussion on some of the later slides when we start to apply these frameworks. Okay. Great. Okay, so moving on, just on the finance piece. So, what are investors looking for? So they're really looking for two things. The first is whether the firm is financially healthy. And financially healthy here really means three things. Number one is the firm profitable or can it be profitable? That is, are the revenues consistently higher than costs? That doesn't mean it needs to be profitable today. But if it's got strong growth and strong fundamentals, then it could still be an attractive opportunity. Look at all the companies in the market today in Silicon Valley that are not even close to profitable, but hugely interesting to investors. Number two, the manageable debt. Something I say a lot is that companies don't go bankrupt because they run out of money. Companies go bankrupt because they have debts they cannot pay. Debts are legal obligations in terms of money they have to pay back. And so so those obligations are very important to investors. Not only because if you can't pay it, you might have to declare bankruptcy, but because those interest payments can really restrict your ability to use the money for other things. So that's something to pay a lot of attention to. And sufficient liquidity. This is essentially having enough money in the bank for contingencies, for things that are unexpected. So one thing I can tell you with certainty is that no investment goes as expected. There's always something unexpected in the future. And so there just has to be enough cash on hand or liquidity or assets to be able to survive those unexpected shocks. Right? And then the second thing they look for is, can you create value out of that investment? Can you turn my $1 into $2? And the way you turn $1 into $2 is by increasing the revenues and or reducing the costs. So an important note here is that a firm can be profitable and financially healthy, but maybe they're not able to create value from the new investment. Think about a company that's grown, that's a market leader, that's profitable, but perhaps they are going to find it very difficult to grow because they have most of the market already. And so investors want to know what they're going to do with your money, right? So with this framework, so where do investors go to look for this information? So every business has a lot of information already because they have obligations to report their performance to management, to shareholders, to the government, and to their other investors. And they report this information on three different financial statements, three financial documents, which are the three primary ones. So they're all contain financial information, but they're all answering very different questions. So the balance sheet is, what does agribusiness own and what does it owe? As I mentioned before, these are where things like loans and assets come in. The income statement is essentially, is the business profitable? If not, how far from profitable is it? And what are the main costs? And then the cash flow is a very important document, which is essentially the cash that enters and leaves the firm. And we'll talk about why that's important in a second.
Mark,
yeah.
Before we move on, there's a couple of questions that maybe you can take at the moment. Does that work for you?
Sure. So yeah, I see the question. Does it matter what the agriculture product is, for example, improved seeds or new ag technology, or some principles regardless of the product? I would say that the framework doesn't change. Maybe the time horizon, well, what you look for is different. When we're going to go through some examples, some sample balance sheets, and some cash flow statements with some specific examples. Maybe we can revisit your example. For example, for a product that is already widespread in the market and it's got a very low profitability, efficiency really matters. And so you might be looking for, can the firm scale? Can it really grow quickly? Because it makes so little money in each product that it really needs to grow. Versus a product that's very profitable, where growth isn't as important, right? Because you can make money just even with a small volume. But the same framework of expected return versus risk and transaction cost is the same. And then maybe your time horizon is different. So, the example about an improved seeds, we actually have an example of that later in the presentation. And so I'm going to come back to that question later in the presentation.
Great. There was one more question, which was why, we talked about risks. Why do agencies like OPIC say that investing in agriculture is too risky? Is it because the return is so small compared to the risk?
No, well, two issues there. One is, well, first we need to distinguish between perceived risk and actual risk, right? So a lot of firms think that agriculture is risky, but in reality, they just don't know the sector. And so a lot of this is about education and demonstration effect. And in fact, a lot of the tools that USAID, the tools that USAID uses, most are meant to be temporary. And they're meant to be temporary because if you can incentivize the private sector to get into this agriculture space and invest, they will see for themselves that it's not as risky as they think. And so for the next round of investment, it is not needed. That said, there are real risks in agriculture that are unique, for example, weather. And we're actually going to go through each of those risks and later in the presentation, and then talk about kind of what mitigation plans you can have to compensate for them. Because so, if you go back to the framework, the expected return, which is this section, we're going to go through what you look for in the return. And then the risk section, it's not only what risks to look for, but what you can do about those risks and how big they are. And so we're going to come back to that. But it's a great question.
Fantastic. So why don't we move ahead with the presentation right now, and then we can come back to some of these questions later.
Sure. Okay. Great. So these are the three different financial statements as I was mentioning. And we're going to go through each one, fairly quickly, and then we're going to apply some examples. And so we have a table that compares all three to each other. I'm not going to go through every line on this, but just to reemphasize two things. One, the income statement is really to answer the question if the firm is profitable, and it looks at a period of time, last year or the last 5 years or some period of time. The balance sheet is essentially what are the debts and what does the company own. This is importantly, it's a moment in time. So when you look at a balance sheet, it'll say something like December 31st, 2017. And then the cash flow statement also is a period of time, say last year, and is sufficient cash generated. So, so quickly going through the income statement. So I see a little, okay. So again, oh yes, excuse me. So one important point about all three of these financial statements is that you need to understand each one, but you really need to understand all three together. And just a very simple example here is, let's say the income statement tells you that the firm is very profitable. It's making a lot of money, but you look at the balance sheet and there's a lot of debt. But then you look at the cash flow statement and cash. Some quarters there's lots of cash coming in. Some months there's not a lot of cash coming in. And so the discussion question is, is this a good opportunity or not? And so I'll pause here and maybe invite the participants to jot down any questions or observations they have in the chat window. And then we will reveal one potential answer that we have. Okay. I'm looking at the chat. We've Okay, well, if no one's going to answer, we can reveal our answer. But I would encourage participation as we go forward. So our answer is that this is a good opportunity, but under several conditions. One of the conditions is that there needs to be sufficient cash in the bank to survive, to reach milestones, right? So, if this company is profitable and it's growing, something's unexpected is going to happen, and it's going to need to hit certain targets, right? Growth targets. And so, provided that they have enough cash in the bank, if they have a couple bad quarters in a row, then it is a good opportunity. But it's important to, when making a yes/no investment, to look at all of these factors, right? So that's just one very simple example. And in the case study, we're gonna apply the same framework. So very quickly in the income statement, this tells you how much money a firm is making, right? It's important to know if an agribusiness is making money or not, right? And you go to the income statement for this. And so it's at a high level, it's a pretty simple framework. It's what are the total sales or total revenues or total net sales, whatever they call it. And then what are the total expenses? And then at the bottom of that, you have the profitability or net income. And so how the numbers on an income statement are distributed can tell you quite a bit about the firm. If you look at the right-hand part of the screen, the first way it's structured is you have the total sales at the top and then the cost of goods sold. The cost of goods sold are the expenses that are directly related to producing that good or service. So an example here is if you're growing a crop, the cost of goods sold will include the seeds, the fertilizer, the man hours that go into producing the crop, and perhaps storage, right, and getting it to market. And that can tell you how much it costs to produce that good, and that gives you the gross profit when you subtract that. But you're not done yet, because you still have things which are called overhead costs, or SG&A, sales, general administrative. These are essentially the costs of the back office, the managers or the marketing or the distribution that are also necessary to get that product to market. And then when you subtract that, you have the net operating income. This is essentially the profit or income that's generated from the core activities of the business. And then on top of that, if you have any debt payments or tax payments, those obviously need to be subtracted too. And then when you subtract those, at the end of the day, you have your net income, which is the money which is left in your pocket at the end of the day. And so the way the numbers are distributed on the income statement can tell you quite a bit. And we're going to walk through an example to show you. And one point on income statements is that if you look at an income statement, they can be quite long and there's lots of technical terms, and it can look quite intimidating. But there's really just a couple things you need to look out for. Number one, you should focus on one of the most important metrics. And as we just walked through, it's what are the total sales, what are the total costs, and how are those costs split between the COGS and the SG&A. You also want to look at the biggest numbers. Frankly, there's a lot of line items that are for accounting purposes and not as relevant to the business. And then obviously look at rates of change. So here, 2017 on the left and 2016 on the right. So you can compare one year to the other. So just one observation on this slide is that you can actually see that this good for this agribusiness is quite expensive to produce. I think if you eyeball it, it's almost like 90% of the cost of generating these sales goes into the direct production. So this company, if it's a farm, it has a lot of money on fertilizer and seeds and man hours in the field and very little on the back office. You can imagine other products where it's reversed, right? But that's just an observation. It's not necessarily good or bad, but it's important to understand. But something positive about this firm is that you can actually see that sales are growing quite a bit, 15% a year. That's pretty good, right? So the company's doing something right. But then obviously two concerns that come up if you look at this are number one, that their overhead costs, this SG&A, is growing much faster than sales. So again, this number is pretty small relatively to the cost of goods sold. But if it's growing faster, there's an obvious question of why. And then also, sort of most importantly, is that the firm its sales are growing 15% a year, but its profit is actually going down, right? And so you can look at the income statement to see why. Part of it is the SG&A, part of it is the cost of goods sold, but growth without more profitability just leads to a question, right? So next we have the balance sheet. And again, so a balance sheet is, as I mentioned, kind of what a firm owes and what its what its obligations are. So the official formula is, so actually before I get into the balance sheet, are there any questions on the income statement we can answer here? If not, I'll keep moving on. But I will, we'll pause at the end of this financial statement section and ask for your questions on any of the feedbacks individually or together. So in the balance sheet, as I mentioned, so there's a simple formula, which is the assets equals liabilities and equity. That's a fancy way of saying, the assets is what does a firm own. These are things like the cash in the bank, the inventory on the shelf, the machinery it owns. The liabilities is kind of what do you owe. These are the loans that you typically take out or what you owe to suppliers. And then equity is what you put into the business, right? Yourself. And so, these things should add up. So there's a couple things to look for, which we'll go into in the ratio section. But this is obviously very important, as I mentioned, to look at the financing risk of the business. And to move into an example, of what it looks like. Again, there can be lots of lines. This has been somewhat simplified, but again, you should look at the biggest line items. Where is most of the money tied up? And then understand the current liabilities versus current assets. This is because current liabilities means debts that you have that generally need to be paid in 1 year, right? So this is costs that you need to pay in 1 year. But current assets are things that are resources that you have that you can turn into cash relatively easily. So, worst case scenario, if you need to pay all your debts today, if your current assets are bigger than your current liabilities, then you're in pretty good shape, right? And so this is a good proxy to talk about financial risk. And then obviously you want to look for big changes year to year, right? And as you can see here, as I mentioned, this is a snapshot in time. So there's a date here, 2016 versus 2017, right? So two questions that come out on this, just sort of, eyeballing it that come out to us, is, the cash has gone down, right? So you can see that on December 31st, 2016, they had $13 million in the bank. These numbers are in thousands. But then 1 year later, they had $6 million in the bank. Now, maybe $6 million in the bank is enough, but when it goes down by 50%, the question is why, right? Did you have too much money before? Do you not have enough money now? That's a question that you should ask, right? And then the property, plant, and equipment, 2016, they owned, $88,000 of property, plant, and equipment, and now they own $120,000. So, they bought more equipment, and so they have more assets. So in general, this is good, but it's important to know, if they're going to buy more or buy less, because it's a use of cash, right? And then one positive thing about this balance sheet, as I mentioned before, when you look at current assets versus current liabilities, they have more current assets than current liabilities. It's greater, year to year. So, worst case scenario, they have to pay all their debts. They have the resources on hand to pay for it. So this is just one example. All right. Any questions on the balance sheet at this point? Okay, I'll pause again at the end to see if there's any questions. And lastly, we have the cash flow statement, right? So as I mentioned, this is very important because if you are a business and you have a monthly contract with the customer and you provide them with a good or service every month, you're going to book that revenue every month. It's a contract, you're delivering the good, and that appears in your income statement. However, maybe that client pays you right away. Maybe they pay you early, maybe they pay you late. But when that cash comes in, can be pretty variable, right? And we're going to go through an example. And so how that cash, kind of enters and leaves the firm versus the income statement is something that's very important to understand. And it's important to understand because cash is obviously what runs a business. There's no way to disrupt operations faster than not being able to make payroll, for example, right? If there's not enough cash in the bank. And so there's three ways that cash kind of enter and leave a firm. one is cash from operating activities, which is kind of what I mentioned before. It's the timing of payments. It's costs that are on the income statement that aren't really cash costs. Depreciation, which is when you buy an asset and you have to expense it over time. It's not kind of a cash cost, right? And timing of payments. Then you have investing activities. This is when you're investing in kind of property, plant, and equipment and machinery. If you spend $1 million of cash and you buy some tractors, that's not an expense. You're shifting cash to an asset that you own, right? That has value. But obviously your cash balance has gone down by $1 million. So that's important to understand. And then cash from financing activities. You're raising money, you're raising debt, cash is coming into the firm, or you're paying back debt and cash leaves the firm. And so all of these things will contribute to how much cash you start with and how much cash you end with in the bank. It's important. And one example here, which we have, again, things to look for. These can also look complicated, but there's just a couple major lessons to pay attention to. Number one, if the firm is cash flow positive. As I mentioned, how much money a firm makes on the income statement can be different than if the firm is generating cash or losing cash, right? Which we'll review in a second. And then obviously where that cash is either entering or exiting the firm, whether it's operating, investing, or financing activities. So just kind of a couple of observations on this sample cash flow statement. Obviously it looks here that they bought a lot of inventory in 2016. As I mentioned, they spent $3.5 million basically buying inventory in 2016, but they spent less than $1 million in 2017. So again, it's not good or bad, but it's a big change to pay attention to. And then obviously you can see that even though the firm is making money, if you look at the top, the net earnings, $1 million of profit, net income, it's really not making much cash. And so that's sort of important to understand. And then, but something positive that we see on this, is, this firm does have access to the capital markets. It looks like they are able to get loans and they're able to pay back loans and to fund any short-term unexpected financing gaps, right? But then one big concern actually here, if you look at their accounts receivable, what this line here means is that if you look at 2017 and you look at $2.3 million, that means that they have recognized $2.3 million of revenue on the income statement, but their clients haven't paid yet, right? So they've delivered the good, there's a contract, they've booked it, but for some reason they haven't received the money yet. And this is quite a jump from the previous year. And so, this is why it's a good example of why it's important to look at, more than one financial statement together. So I went through these fairly quickly. Again, we're going to do another example that we're going to walk through together in the interactive case session. But I'll pause here and ask for any kind of questions or comments on the three financial statements before I turn it over to Sham to talk about how companies use these, or how investors use these statements to generate simple calculations to analyze financial health. Okay, well, if not, I'm going to turn it back to you, Sham, and you can walk us through the next section.
Great, thanks very much, Mark. And as mentioned, again, this was meant to be just an introduction to this topic. If as you kind of dig into this and get more details, you'll see obviously much more nuance and detail than what we're providing. But we want to give a little bit of an introduction to what financial statements can look like. Now, where to kind of go with financial statements? So we did a bit of analysis that Mark walked us through based on just eyeballing some numbers. But there are some kind of specific calculations that investors do. And these are kind of very simple calculations that any person who looks at financial statement can do. And it gives us a good sense of how healthy the firm is and how, quote unquote, investable the firm is. And so today we'll talk through 4 of them. One is on profitability. So we'll talk about the gross margin. We'll also talk about two as it relates to risk. So one is debt to equity, so how much debt a firm holds relative to its resources, which essentially talks about how much can the firm actually meet its long-term obligations. And then liquidity, how many assets can actually be used to fund operations. Sometimes firms end up with lots of assets that are very illiquid, so they cannot be sold easily, and they can't be transferred for cash. So if all the debt is called immediately, they won't be able to honor it because it's tied up in equipment or it's tied up in assets that can't be made liquid. So what is the current ratio? And then finally, in terms of efficiency ratios, especially talking about how well a firm manages its finances, we'll look quickly at the inventory turnover and give a quick example there. So we'll dive into each of these in detail now, and I'll pause at the end of each of the ratios for any questions or thoughts that folks have. Before we dive in, just a quick one. How do people use ratios and how do investors use ratios? There's two ways in which they're used. The first is in trend analysis. So this is essentially showing how ratios change over time. So much like Mark did on the statements comparing absolute numbers next to each other, you can compare gross margins and how they change, for example, from 2016 to 2017. And it is a way to evaluate performance. However, it cannot just be taken at face value because there may be external factors that aren't being taken into account. So it's worth taking that with a grain of salt. The other way investors use them is that they have a set of kind of ratios or comparable benchmarks for similar types of firms. Now, for agribusinesses, this can be sometimes more difficult because they tend to be more niche or they tend to be more specific. And so the extent of ratios and benchmarks that exist are lower, but they do exist. And so, for example, when investors are comparing investments one to the other, they will kind of look at a standard ratio for a gross margin or standard ratio for inventory turnover for a comparable company and see how that company does against that benchmark. So two ways. We won't talk about this in super much detail, but just so you know how they're used. So let's talk about profitability ratios. So there's two that we're going to talk about. The first is the gross margin, and the second is the net margin. And so this comes up often when you're talking, for example, with an agribusiness or even with an investor and say, oh, the margin just isn't high enough, or that had a very low margin. What does that mean? So what it means is there's two ways of thinking about it. The first one is the gross margin. And so that's, as Mark said, you kind of take the revenue and then you cut it multiple ways. So this is just the revenue minus the cost of goods sold, so the actual cost of producing or selling that good over the revenue. And essentially what that's saying is how much balance is there, what does that ratio look like, and do you retain high profits after the direct cost of producing that service? And then the next one is the net margin. So that's actually the profit you have at the end of the day, or the net income you have at the end of the day, divided by the revenue. And that's trying to say is if the firm is profitable after paying all the costs of the firm. So taxes, debt payments, etc. A couple of just points to mention for agribusinesses. The first is that commodity agricultural products will generally have low gross and net margins. And this is because they tend to work as kind of a low margin, high volume business. And so they will have low margin on specific products, but they will sell a lot of it. And so that's how they make their profits. And then the second thing to note is that the net income can vary a lot. One of the comments earlier from one of the participants mentioned weather risk. And that can often be a big determinant of whether in a given year an agribusiness is profitable or not. And so it is worthwhile kind of looking across a number of years as opposed to just comparing one year to the next, because they can be very susceptible to individual changes. So maybe just a quick quiz, and we'll do two of these. So I'll talk about the first one and then make a second one a bit more interactive. But if you were to look at this income statement, again, a very simplified one, but again, looks very similar to the one that we talked about earlier. Using data from the table, how do you calculate, number one, the gross margin, and then how do you calculate the net margin? And it's worth noting here, in this case, the net income is actually negative. So that immediately tells you that this company is somehow in trouble, or they're not making profit after covering all their costs. So if you were to calculate the gross margin, in this case, that would be the revenue minus the COGS. 100,000 minus 40,000 divided by 100,000, so 60%. And if you look at the net margin, it's actually negative 5%. So that's negative 5,000 over 100,000. And so what is this telling us? It's telling us that yes, actually the profit margin you get from just selling the goods, from just the cost of goods sold is actually quite high, but as a result of, in particular, a really large operating expense, the actual net margin is actually quite negative. And so there's something here that's not quite working. Maybe the balance of operating expense to the cost of goods sold is actually it's higher. Maybe it's something to be rebalanced here in order for them to have a more positive net income. And this can happen from year to year. You can have positive gross margins and negative net margins. So I'll quickly, before moving to the next one, I see a question which I'll come back to in a second, which is a slightly broader question on equipment inventory. But any questions on the ratio, the profitability ratios? Okay. Here on, I'll move on to the solvency and liquidity ratios. And again, these are around risk. So how do you manage risk in the business, or how do you determine whether or not a company is risky or not? And so there's two that we'll talk about today. One is debt to equity. And so to what extent, how much is the equity covered by the debt in some way? So the total equation is total liabilities over total equity. And if there's a high ratio, that means that a lot of the financing has been provided by loans. And so it's really saying that it's actually not self-financed, but actually through other people, which means that when it comes time to paying the debt, you'll have a high amount of debt to pay other investors. And then the second one is on liquidity. So as I mentioned, sometimes your assets are tied up in non-liquid assets. And so to what extent are your current assets over your current liabilities? So what does that proportion look like? And if the ratio is higher, that means that you can pay off your short-term commitments more easily than you would otherwise. I hear a sound. I'm not sure if someone's trying to come in with a question. Oh, perhaps not. There may just be background noise. Okay. So just moving on, what to look for in agribusiness. So we do pay attention to the current ratio because it can be a good proxy for financial risk. And look at the property, plant, and equipment in relation to total debt, as they're often directly linked. And so we'll see that on the next page. So this one I'll try and make a little bit more interactive. So if you were to look at this, again, a very simplified balance sheet, and you were to calculate the two ratios, debt to equity and then the current ratio. So again, you have the formulas on the right-hand side. Debt to equity is current liabilities over total equity, and the current ratio is current assets over current liabilities. So if you were to do that, what numbers would you come up with? And maybe just if you don't mind throwing that in the chat window for debt to equity and the current ratio, I can give you a minute to do the calculation and then share our answer. Okay, so I got a couple of private messages, both of which were right, which is great. So the debt to equity ratio is 10,000 over 15,000, just close to 0.7. And then the current ratio is 10,000 over 10,000, which is 1. So again, if you go back to what does that mean? It means that for the first one, the debt to equity, there's a lot of debt to equity. And so actually there's more risk since the financing has been provided from loans. And essentially in the second one, there's a 1-to-1 ratio between the current liabilities and the current assets, which means you can pay it off, but which is good. And it's a stronger position to pay off the short-term commitments, which is a good sign. The last set of ratios, which we'll quickly go through, are the efficiency ratios. And we won't do an exercise here just in the interest of time, but just something for you to be aware of. And this is particularly important for agribusinesses because there's high turnover in an agribusiness. Seeds are sold very quickly. Agricultural equipment is sold very quickly to a number of people. And so there is an emphasis on these types of ratios as it relates to agribusinesses, which is why we're including it. The first one is the asset turnover. So to how essentially revenue over total assets. So to what extent is your total assets covered by your revenue? And the second is your inventory turnover. So how quickly are your products actually how long are your products sitting on the shelf? Or how fast are they moving off the shelf? And so what it helps to look for is two things. One, is the agribusiness highly dependent on assets, such as machinery? And that's fine if it is, but it's helpful to know. And the second is, if there is a lot of inventory kept on hand, what does that mean for the firm? Does that mean there's actually a reason for that? Does that mean that we're not investing enough in marketing to get inventory off the shelf? Does that mean we're over-investing in just producing as opposed to reducing production in favor of sales? So again, as I mentioned, we won't do a quiz here, but it is just wanted to show you what those were. And again, coming back to the point we made initially, the purpose of this isn't to kind of fill your head with a lot of different concepts and terminology. It's just to give you a bit of a very layman's approach to how do people use ratios, how do investors use ratios. And so essentially, ratios can be used to essentially determine to what extent there are different types of scenarios. And you can see that through the financial statements as well as through ratios. So in one situation, it can be that there's too much debt. And that can put the firm at a high risk of bankruptcy. And so how would you look at it? You'd find it by comparing the loans on the balance sheet compared to the assets. And so there are a number of loans. In fact, the loans are bigger than the assets, and actually they probably have a lot of debt. The other way to find it is potentially on the income statement is looking at the interest expense payments and see how they are relative to the net income. So again, these are comparisons you can do to get a sense of what is the extent of debt exposure of the business. The other thing to look at, and this again comes a lot for agribusinesses, is there's a lot of seasonality in agribusinesses. You sell at the beginning of the season, but not at the end. You sell during the rainy season, but not during the dry season. And so there is a risk associated with that, which is in periods of low cash flow, agribusinesses may not be able to pay back their everyday costs. And so you can look at the cash flow statement to see what this variation looks like. And then finally, inefficient cost structure. So are firms overspending to achieve growth targets? So are there huge growths in the SG&A costs, the operating expenses that are growing faster than revenues or costs? So in the first example, we talked about the ratios of kind of a firm with a high gross margin but a negative net margin. That is an example of an inefficient cost structure. Something is not quite right in how the firm is structured, and so it is resulting in a negative profit. So I'll pause here very quickly, but what we want to go to next, and I think people are anxious to get this, so we get all this, we understand what ratios do, we understand what the basics of financial statements are. But how can USAID improve the financial attractiveness of different agribusinesses? So what are the tools and approaches that are available to USAID to actually improve the financial health of a specific or a collection of agribusinesses? And the tools available to USAID generally in this space are fivefold. There are two that are associated with finance tools, so grants and guarantees. And we talked a little bit about guarantees on our last webinar on DCA. And then there are three non-financial tools, so policy advocacy, convening, and technical assistance. And so what we'll do is we'll go through one by one, just to get a few examples of how USAID can use grants or policy advocacy and technical assistance to really help individual or collections of agribusinesses improve their financial health. Assuming that in fact you've done a bit of analysis, you understand their statements, and you understand in fact, yes, there are specific things that can be done to improve their financial health. So grants, how can grants be used? So grants can be used, for example, in two ways. One is funding development of new products that can increase revenues. So it could be, for example, that a firm that's focused primarily on, let's say, the rice value chain has been focused entirely on seeds and has focused entirely on selling rice seeds and is now a medium-sized business. Are there specific adjacent products, seed support mechanisms, or even CTA or seed extension services that the same firm could do to help increase its revenues? And part of what USAID can do is help write a grant to this company to help them explore whether or not something like that can even be possible. And similarly, you could also subsidize the cost, startup cost of a new initiative. And so that could be a similar, again, like maybe the seed company wants to set up a extension service, but they're not sure how to do it. Can you set up the startup cost and fund that until this is actually quite successful and self-sustaining? So again, an example of how grants can be used to help, in this case, an example of a company diversify its income streams and ultimately increase its revenue, increase its profit. A second example is guarantees. And so this, again, we talked a lot more about this last week or 2 weeks ago on the DCA webinar, and we'll refer you more to that. But you can use loan guarantees to increase funding available to agribusiness. So someone asked earlier around why OPIC doesn't lend or why others don't lend. And Mark very rightly talked about perceived risk. Oftentimes financial institutions perceive the agricultural sector to be very risky, and so don't even want to broach it. Providing first loss guarantees or providing loan guarantees can actually be very helpful in reducing the risk for investors and essentially enabling them or making them more willing to invest because their perception of risk has gone down. So that seesaw slide that we saw at the beginning has now been more balanced, and so people feel, investors feel more likely to want to do it. And again, this is something, there are many more examples of this in the DCA webinar, and I would encourage you to refer there for more details on how guarantees can be used. And then finally, for the non-financial tools, there are 3. So in terms of policy advocacy, oftentimes there are issues that limit the agribusiness's ability to actually access finance. There's a good example in Ethiopia where agribusinesses often found it difficult to access finance because of fairly restrictive caps on foreign exchange, how people could use US dollars, etc., to actually be able to purchase equipment or purchase necessary products to be able to operate their business. And so in that case, USAID worked with the local government through a pretty long process and through the ISP program to essentially reduce those caps on foreign exchange, making it easier for agribusinesses to access foreign capital, which in turn enabled them to finance their operations more effectively. So that's an example of how policy advocacy can be very helpful in terms of positively affecting a agribusiness's finance. In terms of convenience, there can be market linkages that agribusinesses sometimes don't see. So one of the great boons of USAID is this bird's eye view of an overall sector in a market or in a country, and they're able to see linkages where it happens. And so they're able to connect with buyers, with suppliers, they're able to connect customers with policymakers. And so there is this very much a kind of a linkage that can happen. And we've seen this kind of used to great effect. Again, in Ethiopia, there's a good example of developing these investor guides, and essentially bringing together investors and investees and to essentially understand how they can work together. And USAID essentially convened that to essentially create these market linkages, which is a great way ultimately to boost a firm's revenues. And then finally, technical assistance. This is an area that USAID definitely excels in, and there are many different aspects of agribusiness, agronomy, agricultural development that USAID does very, very well. And so using that expertise in-house to help agribusinesses improve their operations, improve their structure, can often be very, very powerful. And this can come alongside, it actually can be before investment is done. It can be as a result of kind of a pitch that an agribusiness makes to an investor, and they say, you know, if only you did X, Y, or Z, USAID can come in and help them do X, Y, or Z. It could be improve their management team or improve their operations in order to make them more attractive for their investment. So I'll pause here and would love other reactions or thoughts in terms of other things that people have seen in terms of how USAID can work with agribusinesses to help them improve their financial health, because that in turn helps them improve the overall agricultural sector in the country. So any further examples or reactions is welcome. Feel free to jump in either directly on the audio or through the chat function. Okay, So again, feel free to jump in with other questions as needed. We'll talk very quickly. Oh, there's a good question here. Are there USAID case studies where this has been done successfully? Yes, there are, and we can share a couple as one of the products we're doing as part of this overall webinar series. We're creating case studies around different interventions that USAID has done in this space, and so we'll be happy to share a couple of those with this group afterwards. If there are other folks who want to jump in with their own experiences, happy to hear those as well. But Anna will definitely share those with you and the team after this webinar. Great. So we talked at the very beginning, Mark mentioned this kind of a two-part framework. Essentially, you use financial statements and ratios to understand the financial health of a company, but you also want to understand how investment will create value. And so, and we won't have a lot of detail on this. This is just so you understand what we mean by quote-unquote creating value. But how can an investment create value? It's really about, do we see this investment as being able to increase profitability either today or into the future, and ideally into the future? And so really a good example of this is, a new tractor, if it's purchased or leased, while it does have an initial cost to it, it can in fact be a huge productivity asset to the agribusiness of whatever source it is. And then the second one is how investors essentially how can investors tell if a specific investment will create value? They will make subjective assessments about how they create value through the analysis of industry, competitors, financial statements, etc. And so, again, there's a lot more nuance around this and probably a whole field of study there. So we won't go through a lot of detail, but this is something that investors will look at before kind of agreeing to an investment. So I'll pause here before we jump into what I believe is the next section. And there are a few key takeaways that you can read here. But for this, there's a couple of questions. And so maybe I'll invite Mark back as well, if he can jump in on a few of these. One question is, how do you create demand after a business is established, especially if it is a small company with limited assets? This is a great question, and there's no one easy answer to this. Part of what USAID can do is to help us actually connect with large institutional buyers depending on the product. So for example, there is, I know, some efforts underway in some developing countries to link up local food producers and local businesses with airline companies who are often trying to source food locally, and they do have a sustained demand. And so is there a way for them to integrate into a larger supply chain? That's also been done with kind of larger conglomerates as well, to essentially ensure that demand sustains beyond, just the length of initiative. There's a whole other set of things around just a market creation approach. So how do you kind of create demand for a product? This can be very difficult. And so in certain cases, for example, creating demand for fortified foods can often be very difficult because it doesn't come naturally in some cultures in some regions. And so that can often be a challenge of kind of creating sustained demand because it involves changing consumer preferences. So the short answer is there's no kind of one size fits all, but there are kind of ways in which to think about integrating smaller agribusinesses with larger supply chains to create some sustained demand. Mark, I'm not sure if you add anything to that.
Yeah, the only thing I would add to that is that sometimes you can't create demand, right? And that can be very important to know as well, and actually provide a lot of value. So through the example that Sean gave of doing a grant, just test to see if there's a market for a new product, maybe there isn't. And that will ultimately save both the company and the investor a lot of time and money into investing something that doesn't have potential. So obviously sometimes it's an information problem or a connection problem or a technical capability problem where USA can definitely play. And sometimes people just don't want it. But knowing that second case can provide a lot of value as well.
Great, thanks, Mark. And there's one more question that came in around it's a more technical question. How equipment or inventory is sometimes counted as debt or an asset? How do you think about where it falls? Mark, do you have a perspective on this? I know this is a more technical question, so we may have to take this one offline. But if you have a perspective, and can you turn your video on, Mark, if you get a chance?
Yes, apologies for that. So yeah, typically when you own something, there's a certificate of goods which shows that you own it, and that means it's on the balance sheet as an asset. So if the company owns it and there's some legal proof of that, it's an asset. If you are renting it, then it's not on the balance sheet. It's more of an expense. You're paying a monthly cost. Now, I think of what you're getting at is typically what a lot of companies do is they will take out debt to finance an asset. And so when they do that, it does appear as an asset on their balance sheet because they own it. But on the other side, there also is a debt on their balance sheet for the bank, which corresponds to what they need to pay to fully own that asset over time. And so having an asset does help you get loans for the bank because it's something called a secured debt, right? When you get money and it's if you can't repay it, the bank can seize something that you own, right? But they obviously look at that in the wider context of not only do you own it, but what other obligations you have. But these are kind of the questions that you can formulate by looking at the financial statements. But it's good to verify, in the discussion with the investor as well.
Great, thanks, Mark. One more question came through. Can you talk about the ratio of debt versus equity in different types of agribusinesses in Africa, or in particular agribusinesses, as they start up and then get larger? What are some guidelines to assessing what kind of financing is most needed when? This is a great question. It's also a very nuanced question. And I'm happy to take a stab, and then Mark would welcome your perspectives as well. I think a couple of reactions. One, there isn't, unfortunately, yet a really strong data set, and this is something that actually we're developing and is being developed, around how do you do good benchmarking in this space. So what is a good debt to equity ratio for different types of agribusinesses, particularly smaller ones, and particularly those in Africa. And so while we do want there to be kind of better reference points, there aren't at the moment. There are obviously some kind of general guidelines, you can say. So processors and transporters will have, just by necessity of their business model, will have much higher asset financing needs because of the nature of what they do than, for example, a small cooperative, where the asset investment may be much, much lower. And so how that's financed will differ as well. The other challenge in sub-Saharan Africa in particular is that financial markets aren't, at the moment, well geared to finance assets for the agribusiness sector. And so a lot of the stuff in an ideal world would likely be financed through debt, but it's sometimes not, because people find it very risky to do. And so that's a lot to say that kind of the way it is right now isn't necessarily the way it needs to be. And part of this is how do you kind of move away from kind of the equity-based model or the self-finance-based model or the stunted growth model to one where debt financing and short-term financing, working capital financing can be more effectively leveraged for this type of asset and this type of growth. But I'll pause here, and Mark, I don't know, welcome you, or any thoughts you'd add to that?
Yeah, I'll give an admittedly unsatisfactory answer, which is it depends, right? That every segment or every different product in agriculture has different rules. Sometimes a lot of debt is good, sometimes a lot of debt is not good. So the best way to sort of go about that, I would say there's two things. One is the benchmarking. So Sham mentioned before kind of the ratio analysis you can do. Is you can just compare the debt of one firm versus other firms that you know in that industry. And then just talking to investors. This series is ultimately about how to engage with the private sector. And so, we're not trying to give you the answers about how to diagnose perfectly an agribusiness just through its financial statements. But this seems to be kind of a great question that you can ask an investor, that you've noticed that the debt is very high. Is this concerning to you or not based on your experience, right? So those are just kind of two tips to use.
Great, thanks, Mark. So we talked about a few key takeaways, and I'll just wrap this up. I won't go through all of these because they've been on the screen for a while. I think the only one I would really focus on is you don't need to be a banker to identify financial concerns. So hopefully what the message we're leaving you with is that there's some simple ways, some simple analyses, some simple comparisons you can do in what can seem like a very intimidating set of numbers and financial statements to get a sense of kind of how this company is doing. And even if you're able to do some of these basic ones and some of these initial ones, you'll be much more fluent and capable to understand where things are working and where things are So don't feel like you need to be a banker, you don't need to be a financial expert. This is as much an art as it is a science. And so do feel kind of empowered to be able to look at some numbers, do some quick analyses, and then ask the right questions to be able to get to that insight. So with that, I'll pause this section, and then Mark, I'll pass it over to you to take us through the next section.
Okay. Any questions up until this point?
I'll just ask you to turn your video on again, Mark.
Okay. Apologies. Okay, great. So as we mentioned in the beginning, the central framework that investors use is the expected return versus the risks and the transaction costs. So we've spoken now about the return. So now let's talk about sort of the risks that investors look at. And here I think there's a question before around climate change, right, which we can get to in this section. So sometimes, as mentioned before, the return can be great, right? It could look like a very profitable opportunity, the firm needs capital. But then when you kind of go further in the analysis and you look at the risks and transaction costs, it doesn't make sense, right? And so what are some of those risks? So in general, as we mentioned before, there's lots of different risks in agriculture. But in general, they can be divided into kind of external risks, risks that are outside the firm. We'll go through, and then risks that are inside the firm. So external firms, as we talked about, there's weather. That it's a drought or flooding or a hurricane can kind of literally wipe out an entire crop, right? And so that's a real risk. Dependency on partners and markets. As you all know, agriculture exists in a pretty tight supply chain where there's input providers to the farms, which need to go to the market. And so when there's that dependency, there's a lot of risk as well. And not only on your partners, but on prices, especially for commodity products like coffee or rice, or the price can be pretty variable, right? And then local infrastructure. Obviously, in these countries, you need roads, you need ports, to get your products to market, right? And then within a firm, there's a lot of things that investors look for kind of at the firm itself. Number one is the management team. What investors almost look for, the management team is almost more important than the business model. That's a pretty strong statement. But as I mentioned before, rarely are things going to go as expected. And so you want to know that you have a competent, committed management team in place that can adjust to that. Number two, the regulatory and reputational risk. These businesses are regulated. They have brands, often customer relationships, so you don't want to put those at risk with any sort of misstep. And then labor. Obviously, labor is a big one. Labor demand, labor availability are kind of big risks. So as mentioned before, there are a lot of risks. But fortunately, there's also a lot of ways to mitigate these risks. So as mentioned before, on weather, there's different kinds of insurance products you can get. New kinds of seeds are being developed that are more resistant to things like drought. And so there are, to the question before, there are sort of market failures that exist in terms of climate change. Maybe insurance isn't enough. And this is actually a great role for development agencies and for governments to step in, to help fill some of these gaps on a temporary basis. But I can also tell you that there's a market gap that exists, and there's probably a way somebody's looking at it in the private sector to figure out how to compensate for that. And so this is a great area where development agencies can kind of co-innovate and kind of take the lead, right? Dependency on partners and markets. Firms can, vertical integration just means you own the supplier, that gives you inputs, or the firm that kind of sells you output. So a farm also owns a store, right, where they sell it. Fixed price contracts where you're negotiating with different clients to, here's the price I'm going to sell to you no matter what the market price is, right? For example. And then local infrastructure, things like political risk insurance. This is more for kind of force majeure, right? But there are things you can do through OPIC, for example, right? And then the internal risk mitigation. The management team. When you invest in a company, you can do lots of strings attached, right? The strings attached are you need to hire a new CEO. or the current management team needs to stay for 2 years. Or if you hit a certain benchmark, we'll give you a bonus, right? And so kind of ways to incentivize. So there's a lot of tools there that you can use. And obviously on the regulatory risk, as you can look for certifications or do social audits or environmental audits, which you already do. But that is not only a way to comply with social and environmental standards, but also it's good business sense, these days. And from an investor perspective, the terminology is it reduces risk, right? Because it's a good steward, it's a good stakeholder, right? And for labor, similarly, you can provide different compensations structures for labor, right? So I'm going to keep going here. I'm mindful of the clock because we want to leave some time, a good amount of time for the interactive case study. So maybe I'll go through these just fairly quickly. This is the same kind of exercise as before. But the point here is that there's 5 main tools, or lots of tools that USAID can use to reduce risk specifically. This is different from improving the financial performance. This is reduced specifically. So in grants, for example, as we talked about, if a business is interested in launching a new product or incorporating smallholder farmers into a new supply chain, they don't know if it's going to work, and it's going to cost money, so they don't know if they should do it. So by funding a feasibility study, you can get some sense about whether that will work or not. So you prove some kind of feasibility, and then the private sector or the commercial investor invests, right? Guarantees, as talked about before, this reduces the risk for a bank completely. Instead of potentially losing 100% of their loan, now they're only losing 50% of their loan. So all of a sudden on their models, to model different opportunities, everything's changed. So that's a big one. Policy advocacy. Obviously, there's different things you can get, work with the government to provide support in case something goes wrong, to kind of bail out in some ways if there's something outside of the agribusiness control. It's also in the government's interest as well. Convening. Typically when there's a new agribusiness or a firm is expanding into a market, they don't know enough people, and they might have dependency on specific partners or companies. But obviously, with more knowledge about the market and more introductions, they have more options. So they're not dependent on one single supplier or one single customer, right? And then technical assistance, as mentioned before, maybe there's an agribusiness that doesn't really understand insurance or how to purchase it or what it's used for. And this is a great way where USAID missions and development partners can kind of get involved, right? It's a really growing field. So I wish we had time to kind of, I'd love to hear sort of thoughts from everyone on this, if you want to put them in the chat. We have a question and answer period at the end. I'd love to sort of get some feedback on that. And I want to look at the questions now. In theory or practice, what is the distance between a developed research product to market? So I think this is the question essentially about a feasibility study. So let's say you have an idea and you want to know if it's really a market opportunity for a business. So the great news is that this is essentially where entrepreneurs come in, right? And especially today, there's lots of ways you can test new ideas cheaply and quickly to reduce the risk that there is market demand, right? You can set up a pilot project, you can launch in a specific market, you can test different schemes. So there's not a clear-cut answer, but I would say that the step-by-step process of generating evidence, reduces risk. So grants, the limited launches or the market introductions, and that's what companies are looking for at the end. They're looking for evidence. A good idea is obviously not enough. There has to be a business model behind it, and so grants are a great way to sort of fund that gap, right? And also the only thing I would add to that in terms of the R&D product, it's really kind of the size of the opportunity. If it's a huge R&D opportunity, there's a huge opportunity, but it's not very proven, then there's probably going to be a lot more risk tolerance from commercial investors. And let's say less evidence is needed for them to launch than if it's a low market opportunity where they might need a lot more proof that it's going to exist. So it really sort of depends, but the market size is definitely a factor here. Okay, we can keep going. Yeah, and again, I'll go quickly through this slide. But we mentioned the transaction cost, which we haven't talked about, and how the transaction cost of a deal can be pretty expensive. In general, there's a couple different types. The staff costs. You need people to do due diligence, to draft the contracts, to negotiate the contracts, and that can be significant. Travel, especially to these areas, is a big cost. Legal, especially if it's cross-border and you need to understand the local laws. And then currency conversion. This is a really big one for a lot of international investors. And so that's something that's built into their models as well. Right? And so just very quickly, we sort of walk through kind of some of the tools that USAID can use to influence commercial investors. And now we wanted to walk through an interactive case study, and I'll turn it back to Sham.
Great, thanks, Mark. So just given that we have about 7 minutes left, I'll make this a little bit faster than what we initially intended, which is good because we had some good questions, and so good to have the dialogue. But in your pre-read, you got this kind of fictional company, some background information on the fictional company, and a few financial statements. And so in this case, it's a relatively young avocado company in Mozambique called Cosi Avos. They have some risks around kind of sporadic rainfall. There's also foreign exchange risks. And they are trying to grow, trying to get some medium-term debt to support scaling, but they have kind of depleted cash reserves. And so what we wanted to do is quickly walk through a few of the different financial statements of Cosi Avos, just to get a sense of kind of how you would think about analyzing them. So if you were to look at this income statement, and again, coming back to the initial structure that Mark went through, which is look at some of the big line items, so revenue and cost of goods sold, look at comparison between years, look at kind of the net income and see how the big changes there. Are there any kind of big takeaways that you would flag from this? I'll pause just for maybe 30 seconds, and if people want to jump in on the chat, and you can private message or you can do a group message. Feel free to share any thoughts on takeaways from this, and then we'll share our version of an answer. Okay, so a few of the takeaways that we had just based on this, and hopefully you were able to jot down a few. One, the firm is basically breaking even, despite being so young, which is good, but it's also in despite of large sales. So actually, the amount of net income, if you compare net income over revenue, actually the number is pretty small. And so there is kind of there's something going on there. There is, the second observation, kind of looking again, comparing numbers across years, there is strong sales growth from year to year, and there is kind of strong increase in gross margin, which is good, which is increased with sales. But on the flip side, so I mean those are good signs, and so there is like there's a positive element here, but there is an observation that the net income is actually fairly low. So that would be at least a few kind of initial observations. And yes, so someone said steady growth. That is good. Yes, that is definitely one of the key takeaways from this income statement. So if you're then to look at the balance sheet, and again, just to remind you, you can look at these not just on the screen, but also in the pre-read document. Again, a fairly simplified look at the balance sheet. How would you think about what are kind of the key takeaways from this? And again, you can look at how the current assets compare to the current liabilities. You can look at, again, big changes from year to year, if there's any big changes that you see. And then so those are probably the two major ones to kind of look at here. So if you were to do a quick analysis here, what might you kind of take away from this? Yep, someone says, Anna says liabilities have increased a lot. Yes, definitely. Actually a very big change. Yeah, so we'll talk about that. So the firm already has some significant long-term debt. So if you look at 43,000 or 41,500 over the numbers, 121,000 or 130,000, that's actually a big chunk of that, which is being taken up by significant long-term debt. Current assets are greater than current liabilities, which is good. But there is decreasing cash on hand despite profitability. And so that's again, so you compared, this is one example of how you compare the balance sheet to the income statement. So the income statement talked about profitability, and we saw that on the previous slide. And here we're seeing a decreasing cash on hand. So something's going on where even though there's increasing kind of revenues, the actual cash on hand has gone down. And then finally, if you look at the cash flow statement, again, we have 3 years here as opposed to 2. What are some takeaways from this? And again, you can look at kind of how the cash flow changes over time. You can look at where it's coming from, and any big kind of changes, either accounts receivable or in accounts payable, and any changes in PP&E. So that's property, plants, and equipment. So I'll do this one a bit quicker. There is a big expenditure on PPE financed through debt. And so your 35,000 is being financed primarily through 20,000 that's being raised through long-term debt. But the firm is now cash flow negative, mostly due to PP&E. And so that is there's a question here around to what extent is the PP&E actually developing value for the firm. So to the point we talked about financial health and value, there's a question, was that PP&E investment necessary to create value? And there is a positive cash from operations. So if you were to quickly summarize this, what are the major messages? There's strong growth, but cash flow has been negative due to capital investments. So there, that's comparing the income statement to the cash flow statement. And if you look at the long-term debt, there is a lot of it, but there's a little risk of default in the short term. And again, that's looking at the balance sheet. So what excites you? What doesn't? So there's growth potential. So I mentioned steady growth, which is great. There's a possibility that we've made a lot of investment in PP&E and no more is required. But what's concerning, it's barely profitable, it's declining cash reserves, and there's a lot of existing debt. So if you would look at the kind of information, and we've already talked about this on the left-hand side, and you have some additional context. So the company's purchased some weather insurance, it's been unable to find strong local talent, and the debt holder is willing to renegotiate the terms of the loan. So based on this additional information, they're trying to take some steps to mitigate risk, they have some issues with talent, and they do have a good relationship, it seems, with the debt holder. Do you think this is a better or worse opportunity than what we knew before? It'll take 10 seconds to think about it. And again, depending on the investor, you may have different responses. But what is one potential answer? Again, a possible answer. It is attractive investor, but again, if you're willing to wait to be repaid. There are some risks that you'd want to control for, particularly on the talent. You'd want to think about the returns. It's great that there is weather insurance, so they are trying to think ahead, which is actually a very positive thing. But there are some significant financial and country risks. Yeah, and so I've got a comment. Slightly better due to insurance, maybe an IFC loan or impact investment firm putting in some equity or buy down debt. Yes, that's potential. Not sure whether an impact investment firm would do the buy down debt. It depends on the investor, but there could be an opportunity to take an ownership stake. But in this case, I think Cosi Albers would actually be more interested in some debt financing and equity financing. But there's definitely an opportunity here for some investment. Again, if you're willing to wait a longer time period, which is where kind of impact-oriented investors or impact-oriented financiers may be helpful. And then finally, what can USAID do? So imagine this is a case, it's a live case. You're on mission. You're talking to Cosi Albers. What could you do? And so if you go back to the 5 tools we talked about, you could do some convening. You could introduce Cosi Albers to other firms in the private sector to see if there are ways in which for them to build their capabilities. There are potentially technical assistance. Yes, great answer from the chat window. Technical assistance from a donor-funded project to help them improve their operations. And potentially a guarantee, so using the DCA or other kind of guarantee mechanisms to think about how to catalyze financing, this longer-term debt financing that's required in order to reduce the perceived risk. So definitely things, and again, this is by no means exhaustive. This is just one potential answer. And so I realize we've gone a little bit over, so I'll pause here. But if there's anything that we leave you with, it's that there's one quick introduction to how you can use financial information to analyze an agribusiness to get some level of comfort and familiarity with it. You don't need to be a finance expert. This is a subjective decision. I mentioned earlier, it's both an art and a science. There is no clear kind of yes or no all the time. It's not just a process flow. But there are definitely things that you can look for on the balance sheet, on the income statement, through ratios that can get you to a more educated yes or no. And then finally, please ask questions. So there's a lot of questions that you should be asking. Agribusinesses and banks expect questions to be asked, and to do feel empowered and enabled to ask those questions. So given that we've gone over, we're happy to stick around if people do have questions. But if anyone does need to drop off, I'm happy for people to drop off. And if any have questions, Mark and I are happy to answer them at this stage. So we'll stay on for another 5 minutes. But thank you so much for joining. For those who have to drop off, really appreciate your attendance. And do let us know if there's any questions you have after this. I'll give it another another few seconds for people to jump in with any questions they have. Well, great. Hearing no questions, again, we're very happy to answer them offline. So feel free to email us directly or via Viva. And again, this webinar will be posted on AgriLinks in the next week or so with the supporting material. So feel free to reference it going forward. Thanks again for your attention and for attending. Much appreciated. And have a great day ahead or a great evening ahead. Speak soon.
Thank you, everyone.